On today's video, we're going to talk about long-short investing versus TALS, tax-aware long-short investing, and some of the key differences. Hi, I'm Kevin Kroskey. I'm founder and CEO of True Wealth Design. We're a wealth management and accounting and tax advisory firm headquartered in Northeast Ohio and serving clients throughout the country. So what is long-short equity investing? You may not have heard of this before. Long-short investing has been more in the domain of hedge funds for the last 20 or 30 years. It did involve into mutual funds, particularly, say, after the 2010s. There was a lot of funds called 1-30-30 funds. And I'll kind of show you an example of what that is exactly if we peek under the hood. But tax-aware long-short investing combines the long-short component with more improved diversification, simply going long and short more stocks. And it's also going to have a very favorable tax trading algorithm overlaid on it to pursue some after-tax benefits. So let's go ahead and let's take a look. So I have up on the screen here a certain mutual fund that we don't have to get into the fund, but we're peering under the hood here. So if we look at the asset allocation of the fund, you'll see here there's a net, a short, and a long. What you can see for the equity category is there's almost 194% long equity in the portfolio, and there's about 178% that's short equity in the portfolio. When you net the two, it's certainly far from being all equity. You can see here it's only about 16%. The fund name actually has market neutral in the name. So what market neutral means is it's trying not to have any correlation, any sort of co-movement with the public equity market, with global equities. And in fact, if we come over here to this other criteria on the screen, this alternative style, you can see global equity correlation. So this is global stocks, not just US, but global stocks around the world, which US currently is about 65% in terms of market capitalization for that. But there's actually a negative correlation that's there. You can see minus 0.18. So it's negative beta, fancy word. I shouldn't have even mentioned it, but is not correlated to stocks. So in a portfolio, it's good to have some things that behave differently. And of course, they need to have positive expected returns. So you may have bonds in the portfolio. You may have stocks in the portfolio. You may have a market neutral long short strategy like this. Now, if we think about what this means historically, when we think about long short investing, it was much more concentrated. It was basically making company specific bets about like, hey, this company is going to outperform that company. So I'm going to go long Coke and I'm going to short Pepsi. So you take away some of the industry risk, if you will, but it's only two stocks. It's making a very concentrated, not diversified bet. That has been traditionally the realm of these hedge funds. What we're doing in the tax-aware long-short environment is making a much, much bigger bet. Now, we say bet, we're investing strategically. It's not really like we're betting, but essentially we're spreading our risk over many, many more stocks. It's not uncommon to see a portfolio, a TALS portfolio, tax-aware long-short portfolio, having maybe as many as 2,000 stocks within it, depending on the size of it. So those stocks could have, 1,200 that are long, maybe 800 that are short, and you're really kind of going with that market neutral approach. You can also have stock market exposure in there. That's basically called having positive beta. If you want to pursue global equities or US equities or US small equities, you can really have some flexibility in how you're implementing it. But there's two key differences that I would point to. The long short investing of yesteryear, it's still out there, but frankly, with our investment philosophy and with what the data shows, it just doesn't work. It's not a reliable source of expected return. You're making concentrated bets, and typically you do not get compensated for risks that can be diversified. That's been an investing rule that's been around for more than 50 years now. In the tax-aware environment that we're talking about, with this more quantitative approach to it rather than a certain stock-based approach to it, here we're going long and short a basket of stocks. So it could be a bunch of quality stocks. What does that mean? It could mean that they have high levels of profitability. They have high cash flows. They have low debt levels. They have high ROE, more kind of a technical term that you'll see on some screens like Morningstar that we were looking at earlier. And what's opposite of quality? Well, academics had a sense of humor. They call it junk. And what this factor is called, if you will, this investing component, is quality minus junk. And that's simply kind of the opposing traits. Those are stocks with low levels of profitability, high debt levels, low cash flow. All those things kind of comprise a junky stock, if you will. So QMJ, quality minus junk, that's just one example of a certain factor that we would go ahead and pursue in this TALS framework. But wait, there's more. And what's more is really kind of the tax-aware nature of it all. So in terms of being tax-aware, you have to go out of a mutual fund format because any losses that are realized get trapped there. But when you do that, we can implement that through whether it's a separately managed account. We own the individual equities. And when we do that, and because we're investing in a long and short environment, something will always be going up and something will always be going down in the portfolio. So that gives you much, much more losses to harvest and offset any capital gains that you may have. These capital gains, capital losses can be used to offset capital gains, not only from your investment portfolio, they can be used to offset gains from a business sale. They can also be used strategically in a more sophisticated limited partnership investment where you could potentially go ahead and offset ordinary income. Yes, that's right. Ordinary income, the highest tax rate that's out there. So this is what tax-aware long-short investing is at its core. It's using a very good investing process, investing philosophy to go ahead and pursue a better diversified portfolio to add some additional excess return to your pre-tax returns, but then really focus on the tax-aware nature and harvest the ability to go ahead and sell losers that are down and replace it with something that's similar, maintaining the investment strategy and going ahead and realizing some tax benefits to significantly improve those after-tax returns. It could be used in many different ways. If you're a concentrated stock, perhaps you're an executive at a company, perhaps you inherited some low basis assets from a family member or through a trust. Perhaps you were just very good or maybe even lucky with making your own investment and you saw certain stocks soar over the last decade or two and you have a very large unrealized capital gain. We need to prune the portfolio. We need to trim the bushes to keep the landscaping looking good. We need to do the same with our investment portfolio. You need to pay attention to the gains that are going to be realized, but you don't want to let the tax tail wag the dog. The TALS strategy will allow you to go ahead and pursue both pre-tax returns, more diversification, and heightened after-tax returns by implementing this new age long-short strategy in a very tax-thoughtful manner. So who wins? It's TALS every time. Sure, there's some complexities, but that's what somebody like a good advisor can help you manage. There's other ways that maybe you could do it on a DIY basis, but this is something that you really need to understand and be careful with on how you implement. That's our video for today. As my two young daughters always remind me, Daddy, be sure to tell them to like and subscribe. If you'd like to have more content from us in the future, if you hit the subscribe button, you'll be sure to get it. And please, if you like today's video, go ahead and click that thumbs up as well so more people can get access to this content. In the description below, if you'd like to get some more, click the link, go to our website, and here you'll find the tax-aware investing guide. There you'll be able to go ahead and download it, get some more information. And if you'd like to talk with one of our certified financial planner professionals, click the green button at the top of the screen. We'll be happy to answer a financial question and explore a relationship with you. Thanks and make it a great day.
Information provided is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accurateness and completeness cannot be guaranteed. All performance reference is historical and not an indication of future results. Benchmark indices are hypothetical and do not include any investment fees.